Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, we've been so caught up with Tesla's new factories, batteries and vehicle. The Q1 earnings call is just around the corner now, and personally I would like to get some idea of just how well it might go. Now, I didn't have the energy to do my deliveries estimate for this quarter, but I'm feeling well enough to finally do some numbers again. So let's see if we can get some idea of how this quarter might just go. We do have another record delivery quarter, although it wasn't a record production quarter, but the market doesn't care. They just want to see the financials. That's what matters the most. Therefore, we should expect this to be a record quarter for earnings. In addition to that, we're finally getting some sales this quarter that have caught up to some of the larger price rises. Now, yes, there was inflation involved too, but these prices were also increased due to demand increasing so much as well. And that was even before oil prices started to increase on top of that, further increasing demand again. Therefore, I'm hoping for a higher average selling price and an improved margin. In addition to that, we saw some extra one-off costs in OPEX in Q4 that shouldn't be felt in Q1, hopefully thus showing a further improvement in earnings compared to Q4. Alright, so let's work this out. Now, traditionally, my most accurate way of determining the earnings was simply adding the increment of vehicles onto the previous quarter and establishing the average selling price of each model from each factory and the extra models sold from the previous quarter. But now the average selling prices have risen so much, I feel like this would be a less accurate method. Therefore, we will need to try something a little different. I am instead going to estimate the average selling price of each vehicle and then use that to calculate the total average selling price per vehicle. And then for a feedback loop, I will compare it to the Q4 average selling price and see if it is a similar increase in price from what we expect. If any of this sounds too confusing, don't worry, it will all make sense when I show you. Alright, we'll first start with the ASP of each vehicle from each factory. Now the way I'm going to do this is try and match the waiting time from each model with what the price would have been when the customer ordered. In other words, a way to work out the price of the vehicle when the customer actually ordered it, rather than when it was delivered. This will take quite a bit of effort, but I think it is essential. Okay, let's start with Fremont. And the Model 3 standard range from Fremont is currently for sale for $47,000. Wow, that sure increased in price. You can see the estimated delivery date for the Model 3 standard range for this quarter was still when the price was only $39,990. Wow, doesn't that seem cheap now? A Tesla for under $40,000? I said those prices were cheap, so much so that I bought two myself before the prices went up. It just felt like a good value car. Alright, so unfortunately we don't seem to be able to realise much of the Model 3 standard range price increase, so we will lock in that low $39,990 price. Although these are also LFP vehicles, so although the price wasn't higher, the costs should have at least been lower, and thus the profit higher. Okay, so rather than me going into that much detail for each model, you can see how I'm arriving at the average selling price, and it might be a bit boring if I show you each model from each factory. Anyway, the Model 3 that increased in price was actually only the performance one, and only slightly. With all of that, we get an ASP for the Model 3 at Fremont of about $45,000. This is not a significant increase. Now looking at the Model Y, it had such a long wait time that we go back to what the prices were at around September. The long range was still selling for just $53,990, so actually not a major increase in price again. We do the same for the S and X, and they too are missing the big price rises. It seems that this is the reason for the price rises, as the demand is all dating back from so long ago, which is why they don't appear to be being felt this quarter. Alright, so I think I'm actually going to revert back to my usual style of calculating the earnings, as we don't actually have the price increases I was expecting here. In my experience, this method has always tended to be the most accurate. We're simply going to add on the addition of what we had the previous quarter, rather than calculating them all fresh. It would appear my initial hypothesis was incorrect. Now we've researched when the price increases occurred, relative to when the vehicles were ordered. Okay, from there I've estimated the breakdown of the difference in models per factory with the average selling price. Anyway, all of this comes to an additional $303 million in revenue from the previous quarter, and this was mainly felt from the increased production of the Model S and X lines, and due to those vehicles having a higher selling price. This takes us to just over $16 billion in auto revenue. Now the all-important gross margin. Well, I came into this hoping we'd be north of 32%, given we'd seen these price rises of 10 to 20%, but as these have not yet been felt, I'm actually reluctant to raise the margin. There's also the risk that by the time these vehicles were made, that the costs had actually increased, even though they were at the lower price still. On top of that, there have also been supply chain issues, and I believe Tesla have actually had to pay extra to expedite some parts. As much as I would like to see this higher, I'm going for 30.5% gross margin, and this results in an auto gross profit of $5 billion. Then we have the energy and services side of the business. Now, this is just a moot guessing game. It's a guess because we don't get the information on how much energy is being deployed each quarter, like we do for car deliveries. And it's moot because it all pretty much breaks even and doesn't affect profits. But I will just place $800 million in revenue for energy and $1 billion for services. Although if Tesla are using more LFP batteries in their energy storage instead of 2170 cells, then there is a chance of a slightly higher profit in energy. But it's all kind of small relative to auto anyway, and will have a negligible consequence on earnings. Now we move on to OPEX, and I think this is where we make our money. If you recall, we had some extra major expenses last quarter, particularly to do with Elon's exercising his options. These were one-off expenses, but made SG&A pretty high. R&D was also exceptionally high too. R&D was high supposedly due to more FSD advances. However, we don't know what else could be added onto R&D now, namely a potential humanoid robot and dedicated robotaxi. So I'm going to keep R&D at a relatively high level of around $700 million. But I'm dropping SG&A down to just $1 billion, bringing OPEX to a total of $1.7 billion. Now that much less expense makes a major difference and gives us an operating income of nearly $3.3 billion. This is an increase of 25% from Q4. Alright, that's starting to look much better. That is an 18% operating margin too, up from 15% in Q4. That's a really big jump. After tax, we're at a net income of $2.9 billion. Again, about a 25% increase from Q4. Now the all-important GAAP EPS diluted figure. In fact, I think it will be slightly less diluted now that Elon has exercised his outstanding stock options. Anyway, I estimate this figure to come in at $2.63, which is actually a 28% increase from Q4. Now, a 28% increase in EPS quarter over quarter is absolutely amazing. When annualized, it would be the equivalent of 2.7 times increase. So this can be viewed as a big jump in earnings, despite only a minor increase of just 2% in actual auto revenue. But EPS is the figure that Wall Street care about. It's the earnings per share. In my opinion, this isn't really a great quarter, but we knew this already due to the fact that we had the shutdown in Shanghai, and that could have possibly cost us over 10,000 vehicles. Then also this quarter having 2 fewer days than Q4 as well. There's probably a total of 20,000 additional vehicles if we're matching like for like. So that is why this quarter could be considered not great. But getting to earnings, last quarter had those extra expenses too, so that could have also been considered not as great as it could have been. Either way, it looks to be a great jump in earnings. One great thing about this quarter is it finally knocks out the last quarter before earnings started hitting over $1 billion, and this will thus have an effect on the trailing 12-month PE ratio. It changes the trailing 12 months from 5.5 billion to 8 billion, replacing 438 million for Q1 2021 earnings with nearly 3 billion for Q1 2022. That's a really big jump. It would take the PE ratio from about 200 down to about 130 at the time of this video with a $1.02 trillion market cap. And if you annualize these earnings, it would be a PE ratio of around 90 based on just this quarter's earnings. Alright, let me know what you think. The earnings call is early this quarter, which generally tends to be a good sign. This will be the last earnings without Berlin and Texas, so hopefully they'll continue to get better. Although I think margins could be a lot lower in Q2 whilst these new factories are ramping, which I think will also mean Q2 will have a lower EPS than Q1. The spreadsheet is also available in some of my Patreon memberships too if you wanted to use that for yourself. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.